Hey guys, Steve Zalunardo here with Remax West Zalunardo Associates. Today's topic is OFSA. So basically I'm getting a lot of calls from clients panicking regarding OFSA. What OFSA is a stress test regulations that was implemented in 2017. And I just want to distill this down because what's happening is the media has put a lot of panic into buyers, and this is why we had this influx of buying in May where people were thinking they can't afford more properties. But let me break it down for you a little bit here. If you're putting less than 20% down, you're going to have an insured mortgage. This doesn't apply to you. This is more for people putting 20% down or a second property will have to go through a stress test procedure, which I'm actually for, to be honest, because what the stress test does is pre-qualifies buyers in case of future interest rate hikes. Let's say a 5-year fixed mortgage is at 2.5%. In 2017, you would have to stress at 4.79%, and now you're going to be, the new regulation change of the B20 was an additional 45 basis points, which brings it to about 5.25%. So you're going to stress test for 5.25%. A little caveat here, I've actually read some great information about this. So going forward, like the Bank of Canada will release a contractual rate, and then they'll add the 200 basis points to that number. Currently, that's how we get to this number of 5.25. So let's just say in the future, the mortgage rates do hike up to, let's say, 4%, and the contractual rate is at, let's say, 5.25%. They're going to put the 2% on top of the 5-year fix because it's a higher rate. So you'll have to stress test at 6%. Small caveat there. Hopefully we never get there, but that's actually written in the actual regulations there. Okay, so how the bank really sees you, this is how the stress test and how the bank is going to view you. So basically in a 5-year fix at 2.5%, your mortgage payment per month would be $3,939. This is your actual payment that you're going to be paying. So pre-new regulation change at 4.79%, this exact same mortgage out of $1 million would look like, in the bank's eyes, you'd be making a payment at $5,212. Let's do a little break here between the next numbers. They're going to basically run your total debt ratio. So basically your car loans, if you get a line of credit, some visas, and they just tack this number on and make sure the total debt ratio makes sense if the market were to adjust and have higher rates in the future. So it's basically a pre-qualification for the hedge of future rate changes on the higher spectrum rather. So let's say post-regulation change, which we're currently in right now at 5.45%, our mortgage payment will look like $5,608. So it's basically, it's a shift of like $400 difference. So it's not as extreme as the media made it out to play. You gotta remember, like the media plays on everyone's fears, and this is, if you're an investor, as I'll say that word again, a good opportunity because a lot of people will be running to purchase anything. So you can kind of sell whatever you want during this period because of the fear of the stress test. But ultimately, if you kind of look at the effects, it's only literally $400 difference per month, which brings it to $4,000 to $5,000 per year. It's not a massive difference. It is a difference, but not massive difference. If you like this video, you can always like, share, subscribe, and that's it, guys. We'll catch you on the next one. Ciao.